All right, good morning, guys. You guys should just get done with your do now. In your own words, explain what a fiat system is in your own words. So remember, fiat system is essentially the kind of system that replaced the gold standard. And it's essentially this large system of economic resources that's built upon lots of credit and debt. And how at the end of the day, there's actually more money floating around out there in theory or on paper or on computer screen than there actually is hard currency, like physical dollars and cents. And that allows people to loan more money, to borrow more money than can actually be printed. So whatever you guys have, make sure you have 4 sentences, get it turned in the white binder. And today we're going to move on to something kind of a little bit different than what we've been talking about. We've gotten the money aspect out of the way. We kind of understand what it is, how it works, where it gets its value. And now we're going to start talking about investing. We're going to start talking about some basic investment terms and some of the stuff we've already covered in the past, but I haven't really given you concrete notes for, so that's where we're going to start with today. So first thing we're going to cover is the term credit. Credit, at least for these purposes, we're going to define as what helps banks and businesses to decide how likely you are or a person is to pay back a loan. So once again, what helps banks and businesses to decide how likely you are to pay back a loan? So you hear about credit or maybe like a credit score. So all a credit score is simply a number that they assign to you that says, hey, this person is trustworthy, this person is reliable, this person's going to pay me back on time. Because banks and businesses, when you go borrow money from them, they don't know what kind of person you are. It's not like if I go, hey, borrow 20 bucks from my brother, he says, oh yeah, sure, I'll loan you 20 bucks because I know you paid me back in the past, so I trust you. They don't know you like that. And so a credit or a credit score basically helps determine that. Typically if it's high, that means, oh, this person's trustworthy, they pay all their bills on time. If they say they're going to do something, they're going to do it. And so that's how that works. Next term we're going to cover is debt. Once again, we talked about it in the past, but I'm going to give you a more concrete definition. And in this context, we're mostly going to be referring to money, but it can't just be vaguely described as something that is owed or due to someone. So a lot of times we are talking about money like my debt is, oh, I owe this person 20 bucks. We could also be in the form of other things like a favor. Like I am indebted to you. Hey, you helped me out that one time, and now I owe you one. So that's all it means. Somebody gave you something, and then it's expected to be returned to you. It's expected to be, okay, I'm going to pay you back in some way. Whether it be money, favors, time, effort, energy, whatever it may be. Next up, we move on to a specific kind of debt, known as a mortgage. So it's one of those terms I guarantee it's what everybody's heard of, but I think that a lot of people maybe simply don't understand it. They hear the term or they might get misconstrued. So a mortgage, all it is a fancy term for a specific loan on a house or property. So when I went to the bank and said, hey, I would like a loan to buy my house, or I would like a mortgage. That's all it is. Mortgage just equals a loan for your house. Just kind of like I would buy a loan or get a loan for a car or something else I want to buy. So it's just a specific term for a loan on a house or property. Now, these two terms these next two kind of go hand in hand. We have the first one, which we've talked about in the past, called interest. This is simply money that is paid in exchange for the lending of money. So my buddy Matt comes to me and says, hey, let me borrow $20 from you and I'll pay you back 25 tomorrow. So he's going to pay me back the money he owes me, the 20, and plus a little extra for basically doing him that favor. And so that little bit of extra, that extra $5 would be the interest. It's like he's paying me for borrowing my money now. Same thing goes with a bank or a lender. They charge you interest. So, okay, I'm going to provide you this service. I'm going to let you borrow the money, which you're going to pay me back, plus a little extra. And that's how banks and lending services make money, off of the interest. That's how they pay their employees. That's how they pay their bills. You know, they stay open. If they didn't charge interest and then just broke even, well, they wouldn't make any money. They wouldn't come out ahead. So we have interest, which is a little bit of extra, and then we have something known as the principal. The principal is the amount of money borrowed that needs paid back. So remember, the interest is a little bit of extra, the extra I'm paying you for doing me this solid, for helping me out. The principal is the actual amount that I borrowed and that I'm paying back. So, for example, once again, my buddy Matt says, hey, let me borrow $20 and I'll pay you back 25 tomorrow. So the $20 would be the principal. That's how much I'm just paying back, and then the interest would be the extra $5. This is especially important when people start looking into loans for cars and homes and things like that. Because it'll say, okay, here's how much your principal payment is, and here's how much your interest payment is. And so it'll be two different dollar amounts. And so it's always good to kind of be able to distinguish between the two to know exactly what you're signing up for and exactly what you are saying, hey, I agree to do this. Because if you don't understand, then you're basically signing a piece of paper legally binding you to this, and you don't even understand what's going on. So I'll step aside for just a second. Go ahead and hit pause and get the rest of the notes copy if you need to. And there should be a YouTube clip attached to this, so go ahead and pause this and press play, and we'll go back in just a second for the exit slip. All right, so you need a half sheet of paper. In your own words, explain how a mortgage can be helpful and or hurtful to people. So remember, mortgage is a loan on a house or property. So how can a mortgage be a good thing and a bad thing, essentially? 4 sentences. Make sure you get them all 4, get them turned in the red folder. I'll see you guys next time.